The economy looks healthy, almost reassuring. Markets are steady. Unemployment sits near 4%. Gas feels affordable again. But this calm is deceptive because what you're watching is not balance. It is a sugar high, an economy fueled by debt, by tax cuts pulled forward from the future, by pressure placed on institutions meant to slow excess, fast growth, no foundation. The story being told is success, but the mechanism underneath is fragility. This is stimulation, not strength, a temporary rush masking long-term toxicity, like sugar in the bloodstream, energy without nourishment, a spike that always collapses. And here's the danger. Sugar highs never announce the crash. If you care about what comes next, about 2026, about whether this ends in renewal or rupture, stay with me, because once you see how this system is built, you'll understand why the bill is already waiting. Now let's pause and define the real problem. Let's define the problem. This is not a normal cycle, and it's not bad luck. It's a system optimized for appearance, not durability. We measure success by what's easiest to see: stock prices, monthly jobs numbers, short-term growth. But those are symptoms, not foundations. Real strength comes from productivity, from trust in institutions, from buffers that absorb shocks. Those buffers are thinning. Growth is being borrowed from the future. Demand is being pulled forward. Risk is being suppressed, not resolved. Every lever is pushed at once. Fiscal expansion, trade disruption, political pressure on monetary policy. Each move works briefly. Together they distort the entire system. This creates a dangerous illusion. That speed equals strength. That volatility equals control. But fragile systems often look strongest right before they fail, because distortion hides weakness until it doesn't. To understand why this illusion feels so convincing, we have to ask a harder question. How did short-term thinking become the organizing principle of the economy? To answer that, we need to step back, not to last year, but to the moment this pattern became normal. Then let's rewind, because this pattern didn't appear overnight, and it didn't begin with this administration. It began when growth stopped coming from productivity and started coming from leverage. Debt became the substitute for reform. Financial engineering replaced real investment. Asset prices became the primary measure of success. Every slowdown was treated the same way. More stimulus, lower rates, bigger deficits. At first it worked, then it had to work harder and faster and more often. What was once emergency policy became standard operating procedure. Cheap money masked inefficiency, deficits filled structural gaps, imbalances were postponed instead of corrected. This is how economies lose resilience. They don't collapse, they soften. Buffers disappear quietly. Institutions bend gradually. Risk concentrates invisibly. What looks like stability is often just delay. And delay is dangerous, because the longer consequences are deferred, the more violent their return becomes. That is the historical pattern. And in this cycle, something accelerates everything. A deliberate shock, a conscious decision. The moment when distortion stopped being passive and became policy. That moment is where the next phase begins. That moment had a date, April 2nd, 2025. It was called Liberation Day, a single announcement, a sudden escalation, a baseline 10% tariff on nearly all imports, and on China rates so extreme they stopped acting like policy and started acting like shock therapy. Markets reacted instantly, trillions in value disappeared, volatility exploded, confidence cracked. Then came the rebound, fast, convincing, dangerously misleading, because the real damage wasn't in prices, it was in structure. Tariffs don't punish foreign exporters, they raise costs inside your own system. Importers pay first, consumers pay last, supply chains strain, margins compress, inflation seeps in sideways. This was framed as strength, as liberation. but functionally it was friction, a supply shock injected on purpose. And once you introduce shock as a tool, every actor adapts defensively. Investment hesitates, planning shortens, trust erodes. This wasn't an isolated event, it was a signal, a declaration that disruption itself had become strategy. And that raises a deeper question: what kind of logic treats instability as leverage? To answer that, we have to look at the theory behind the chaos. What you're seeing is not chaos, it's doctrine, a revival of madman theory. The idea is simple: project unpredictability, force others to move first, threaten extreme outcomes, make uncertainty more expensive than compliance, turn fear into leverage. At first it worked. Companies recalculated, capital flowed inward, investments were announced not because conditions were ideal, but because instability was worse. Uncertainty became the incentive. But this strategy has a fatal flaw. It only works once, because unpredictability loses power when it becomes routine. Every cycle followed the same pattern: shock, market panic, political pressure, then retreat, pauses, exemptions, temporary truces. The signal became clear: the system would blink, and once that belief takes hold, leverage evaporates. Worse, rivals adapt, retaliation becomes symmetrical. Pain is returned, not avoided. Supply chains fracture, exports collapse, volatility stops being tactical and becomes permanent. Madman theory depends on credibility, on the belief that escalation is real. But when escalation is theatrical, only the damage remains, and damage compounds. Because while trade absorbs the shock on the surface, the real strain builds elsewhere, inside the fiscal core. That's where the next crisis forms. The pressure didn't stop at trade. It moved inward, into fiscal policy. The engine was simple: spend more, cut more, worry later. Permanent tax cuts, locked-in revenue loss, deficits widened by design, debt became background noise. For a moment it worked. Demand stayed alive, markets stayed calm. Another rush, but this wasn't investment-led growth. It was deficit-fed momentum. Money flowed upward, balance sheets expanded, but fiscal buffers vanished. Flexibility disappeared quietly, because once cuts are permanent, options shrink. You can't raise revenue without backlash. You can't respond to real crises without borrowing more. You can't slow inflation without breaking something. The contradiction sharpened. Fiscal policy pushed prices up. Political pressure demanded cheaper money. Spend aggressively. Cut rates anyway. The system was pulled in opposite directions. This is how credibility erodes. Not loudly, but persistently. Markets don't fear debt itself. They fear denial. And denial delays adjustment until adjustment becomes unavoidable. That was the moment the sugar high crossed a line, from excess to exposure. And exposure never stays abstract. It travels downstream, into the labor market. You feel the shift here first, not in headlines, in daily life. Jobs exist, but security doesn't. Wages rise, but prices rise faster. Work becomes tighter. Hours become unstable. Hiring slows quietly. This isn't demand collapsing. It's supply breaking. Labor shortages push wages up, not because productivity improved, but because workers disappeared. Scarcity replaces efficiency. So businesses raise prices to survive, to pass costs forward. The raise you fought for comes back as inflation. That's the spiral. You earn more, yet you afford less, and the stress accumulates. Because this system rewards imbalance. Less labor creates higher wages. Higher wages create higher prices. Higher prices erase the gains. You're told this is resilience. It feels like pressure. So you adapt. You delay spending. You stay put. That's how fragility hides. If this feels personal, it's because it is. And if it feels isolating, it shouldn't. Because this pressure doesn't stop with you. It scales. And when it scales, it reshapes the world around it. What starts locally never stays local, because modern economies are fused together. When labor tightens in one country, costs rise everywhere. Supply chains stretch, shipping delays multiply, inventories thin, trade slows, not suddenly, gradually. Partners adjust defensively, retaliation hardens into policy, cooperation becomes conditional, growth projections are revised down, quietly at first, then publicly. Capital hesitates, investment shortens its horizon, long-term planning gives way to survival. This is how global momentum fades, not through collapse, but through friction. Volatility becomes constant, uncertainty becomes priced in, trust erodes across borders, economic tools turn geopolitical, tariffs become weapons, alliances become transactional, the world fragments into blocks, efficiency is replaced by redundancy, redundancy raises costs for everyone. No one escapes this, not exporters, not consumers, not governments. When global growth slows, there is nowhere to outrun it. And that leaves only one question. If pressure keeps building and buffers keep thinning, where does this actually lead? From here, the future narrows into only a few possible paths. From here, the future splits not into endless possibilities, but into three. The first path is correction. Pressure is acknowledged, tariffs are softened, institutions are given room to act. Growth slows, pain is real, but the system stabilizes. The sugar high fades without collapse. This path requires discipline, restraint, and political courage. The second path is drift. Nothing breaks, nothing improves. Debt grows faster than output. Inequality hardens, volatility becomes normal, the economy survives, but trust erodes, people adapt downward, expect less, accept fragility as permanent. This is stagnation with motion, activity without progress. The third path is rupture. Buffers fail, confidence snaps, capital freezes. What begins as correction turns into contraction. Not because of one shock, but because too many were postponed. This is how systems fail, not from impact alone, but from exhaustion. Which path emerges depends on choices made under pressure. Because economics is not fate, it is behavior repeated at scale. And the most dangerous moment is not panic, it is denial. Only one part remains, the ending. Here is the ending. This economy didn't collapse, it was hollowed out, slowly, deliberately, by choosing speed over resilience, optics over structure, short-term relief over long-term capacity. The sugar high felt good because it postponed consequences. But postponement is not prevention. The bill always arrives. It just arrives when defenses are weakest. In 2026, the real question won't be how strong is growth. It will be how much shock can society absorb. Because systems don't fail when numbers turn red. They fail when trust disappears, when institutions can't respond, when households can't adapt, when inequality turns pressure into anger. This is not a call to panic. It's a call to see clearly. If you understand the mechanism, you stop being surprised by outcomes. And when surprise disappears, preparation becomes possible. If this helped you see the system differently, stay with me. The next video focuses on what this means for your personal decisions inside a fragile economy, because the most dangerous moment is not the crash itself, it's the moment before, when everything still looks fine,